Hi there, this is Michael EJ coming back to you with part two of the two-part series explaining the PVGO thought process for equity valuation. In this presentation, I will further explain how to apply the PVGO thought process for equity valuation as well as compare it to other approaches to valuation and how they all coincide. As a quick recap, the PVGO thought process is based off of the Gordon growth model, and it uses a train of thought to kind of understand how much an investor is actually paying for growth. The goal of this process is to find stocks of companies that have low growth expectations relative to an investor's assessment of company's risk and potential returns. So there are three main components of the PVGO thought process. There's the economic benefit, the discount rate used, and the growth expectations. And below each, there's things to consider when calculating each input. And depending on the industry and the company and where the company is in its growth stage, there's a lot of things to consider when evaluating each of the three key inputs. So let's dig a little bit deeper into each and see how you can apply it. Well, for starters, let's look at how PVGO relates to a company within their life cycle. Now, a company goes through a typical life cycle similar to an industry. It starts off as just an idea, and you get some backing and you start to create a business model. You start to build the business, start creating revenues, you start growing those revenues to a point where you even begin to become profitable, have even a return on investment. Once that's seen from potential competitors, they'll try to enter into the industry, enter into your space. So you have to defend those competitors as well as enter into new markets. And then at the end, your company might become too large. You have to scale down the business and even consolidate. In each of these stages, there's a different value driver that needs to be evaluated, as well as extreme changes in the discount rate and the PVGO percentage to consider. As a better illustration, let's look at these two graphs. Now, graph to your left, growth and profits throughout the corporate life cycle, you'll see that revenues start off really low to none, and similarly, negative profits. And then over time, things start to grow till you get to a mature, you can say terminal kind of years, and then things start to decline. Now, conversely, when you look to the right, discount rate and PVGO percentage throughout the corporate life cycle, you'll see that as revenues and profits begin to grow, discount rate starts to decline. Companies becoming safer to invest in. But at the same time, there's not as many growth opportunities. When you are a startup, the world is your oyster. So much market potential. But when you're a conglomerate, you can't really invest in new projects. There's no true incremental return on invested capital. So even though you're probably the safest company, not necessarily the best in terms of growth opportunities. So to make the process useful for all economic benefits, I've analyzed the margins for various benefits of the S&P 500 from 2000 to 2015 and compared them to the free cash flow margin, which is the true measure of value creation. Using the inverse of the margin above the free cash flow margin, I then compared the compounding growth rates to that of free cash flow, as well as observed the correlation between different benefits to free cash flow. As you can see, the further you move down the income statement, the higher the correlation a benefit is to free cash flow. Also, notice the high correlation of net income to free cash flow, as well as essentially the same margin. Maybe using EPS and using net income as a measure of value creation isn't necessarily the worst thing in the world, isn't necessarily a bad idea. Based on these preliminary studies, I will be able to adjust the discount rate based on the benefit chosen by multiplying the initial discount rate used by the adjustment per economic benefit. That way, I can capture the additional risk of not using free cash flow. Look, there's going to be times in different situations where you can't analyze free cash flow. And as I mentioned before in the previous video, you can't really use the process unless it's a positive number. So if you're just starting off and all you have to look at is revenues, or all you have to look at is gross profit, this is a way to kind of adjust the discount rate to capture that additional risk of down the line in the future turning this gross profits or turning these sales or even turning operating data or market potential into free cash flow. Now, this type of analysis can be done where you analyze multiple over free cash flow in correlation to growth of a company if you have a good peer group. If you're looking at an early stage company and you can clearly distinguish the competitors, then yeah, you can kind of use those competitors, especially if they're further along in the mature stages, or if they have free cash flow generation. You can kind of use this same kind of analysis. But if not, this is just a good rule of thumb to use if you're just valuing the general market. Also, if using CAPM to calculate the discount rate, I would advise you to make a size adjustment to the discount rate as well, for it can capture the additional risk involved in investing in small and mid caps. I've created a quick rule of thumb table for this as well, as these are the main adjustments I'll be using across multiple videos that I plan to make down the road when looking at different economic benefits for different companies. Another thought to consider is how implied growth rates change as the PVGO percentage change. As an example, in this table and graph, I'm showing how the PVGO percentage affects the implied growth rate over 5 years as well as the expected growth from today. As you can see, the higher the PVGO percentage, the more the compounding effect comes into play as the implied growth rate increases exponentially. This is why it's a good idea to invest in companies with low expectations. Although having higher expectations does not mean a company cannot go above and beyond what's projected of them. Conversely, even if a company has little to no expectations with a PVGO percentage of 5%, as you can see, if a company's in decline, a company's in decline. And if you project the decline into the future, why invest in that company, even with low expectations? They're low for a reason. Now for some application. We'll start with the S&P 500 since 1990. Now, the table you see may be a bit confusing, but let me summarize the key findings. Since 1990, the average market participant could expect a 2% dividend yield, around 8% earnings per share growth, various ways to calculate a discount rate, using maybe historic returns on capital, around 8%, same number probably for discount rate based off of CAPM for equity, maybe around 10%, using the Gordon growth model for cost of equity, maybe around the same percent just based off historical returns alone, maybe a little bit higher if you use return on equity, historical return on equity. But most importantly, over the past 25 years, the average market participant could expect around 35% of the price to be based on future growth expectations, meaning around 65% of the value can be seen today at the midpoint. This equates to over a 3 to 5 year span. The growth expectations of the S&P 500 is around 15 to 16% annual growth over a 3 year span, or approximately 9% over a 5 year span. So with this in mind, let's look at the S&P 500 right now. The economic benefit we'll use is still trailing 12 months earnings per share, which is approximately $104.14 at the time of valuation, which was around middle of September. Discount rate used, we just did a simple CAPM. No need for size premium since it's the entire market. So 7.8% cost of equity. So take those two numbers, divide the benefit by the discount rate, and we get approximately $1,335 per share, the S&P 500 in a no growth. Now, at the time of the valuation, the S&P 500 was around 2140, meaning the no growth value of the S&P 500 represents approximately 62% of the market price, and 38% of the market price represents expected growth in value in the future. This PVGO percentage represents approximately 17% over a 3-year time horizon and a 10% growth rate over a 5-year horizon. Now, in this analysis, the key thing to ask yourself is, are the implied growth rates of the market reasonable, too optimistic, or too pessimistic? Now, from just the initial analysis we did of the overall market, you can make the case PVGO is slightly higher or in that range. So things look all right. To further add to that argument, Standard & Poor's projects approximately 30% earnings per share growth over the next 12 months and about 11% growth over the next 5 years annually. I mean, since this rate is still in between that 10 to 17% range, you can kind of make the case that things still look good in the value in the market. It's not overly heated valuation. It's not too high based off of historical performance, and you can make a case that the current market price is justified. However, to the bearish case, let's keep in mind corporate earnings are not rising; they continue to fall. I mean, this is going to have to turn around, and we don't know if that's going to happen. To add to that case, IPOs are down, which is a huge signal of kind of the health of the market and people's confidence in the market, as well as people feel valuations are just inflated mainly because the debt markets aren't so high. So it's just a trade-off between you want to invest in bonds or you want to invest in stocks. So you have to kind of look at those things to kind of see from both sides, is this a reasonable rate? You can make a case either way. This is just one of the ways you can evaluate the market, additional to looking at historical PEs, historical growth rates, your traditional analysis. Speaking of traditional analysis, let's talk about them. So you got two typical approaches that's mainly used. You can either go the market approach, where you look at different multiples, or you can go an income approach, which is using a DCF, trying to find the present value of cash flows further down the line in the future. There are challenges with both of these valuation techniques that I believe the PVGO process can help fix. Well, not necessarily fix, but lessen the burden. So for the market approach, there are times where it can be really tough to almost impossible to find a good peer group. No two companies are alike. In a lot of situations, no two companies are anything alike. Market valuations can fluctuate dramatically. You never know what's going to go on. One day, it's based purely off of fundamentals. Next day, emotions are completely involved. And it's not based off of the fundamentals all the time. Sometimes it's just irrational behavior. Something's going on in the Middle East, has nothing to do with some of these companies, and yet their price is going down. Most importantly to me, there are implicit expectations baked into market multiples that aren't clear. You can't really tell sometimes what's really within the multiple. Why is this multiple so high? Especially for certain companies that don't have a long trading history. So that's kind of the traditional problems or challenges with the market approach. As for the DCF, which is a favorite of mine, but sometimes it's just tough to use. I mean, it's tough to project, and a lot of people are not comfortable making these far out forecasts and not sure exactly what to put. I mean, if you're looking at an early stage company where you can make the case where the terminal year is probably 20, 30 years into the future, how can you use that company? You can't use that valuation even if you believe in all the inputs, it's tough to defend. Shorter horizon terminal value is just too high, and on the opposite end, it's most analysts are looking at only 5 years and then a terminal value. That works for companies that are going towards maturity, but if a company is nowhere near that, I mean, it's just 90% of the value is coming from the terminal value. It's to me, it's just too much, which leads to why a lot of analysts go with multiples, because in their eyes, using the income approach, particularly the DCF, could possibly lead to garbage in, garbage out. So let's try to tackle some of these problems with other approaches and how the PVGO percentage can help. First, let's start off with valuing just a company. Let's use Apple, biggest company in the world. Let's go there. And we'll look at free cash flow of Apple. So that will be the benefit used. Discount rate I already calculated using the weighted average cost of capital. I already got there. Let's cut to the chase on that. We're going to use 7%. So make the estimation that the enterprise value of Apple with no growth expectations is approximately $573.1 billion. What this implies is that at the time of valuation, the no growth value of Apple represents 89% of the market price, meaning just 11% of the enterprise value represents expected growth in value in the future. I mean, these are some low rates this leads to. I mean, this leads to only approximately 4% growth over annual growth over the next 3 years, and almost as low as 2% over the next 5. I mean, just on the thought of Apple's free cash flow margins in general, I mean, it seems ridiculous to think that this is that low. I mean, you can make a case just off of this alone that these rates are too low, and that this is unreasonable. You can see the value going much higher. Well, growth in free cash flow being higher. I mean, you also got to consider the other side. Other side, companies in more of a mature phase, just trying to find ways to continue the growth. iPhone sales aren't as hot. Then you got the worries over that. So that may be the pessimistic side of looking at things. But let's just say, based off these initial results, we think that the market expectations for growth are too pessimistic, and the minimal sales growth alone can justify the growth expectations. So let's say you believe in equity research analysts' forecast. They're forecasting 8 to 9% annual growth for Apple over the next long term, which equates to approximately 25-30% PVGO. Also, we are making an assumption that the forecasted growth rate for Apple, in this case, it's earnings per share. It's similar to free cash flow, which we've already kind of discussed and shown that you can make that case, and the correlation is already there for Apple. So, based on this range, 25 to 30% PVGO, Apple could be priced anywhere from $130 to $160 per share, or approximately 26% at the midpoint. Well, 26% return. To get to that number, let's look at the bottom table. Showed in the past video how this all equals out. You take the no growth value, like I mentioned before, $573 billion. Use the estimated PVGO percentage. In this case, I used the midpoint in between 25 and 30%, which means you back in and find the estimated no growth percentage. You compare the ratio, use that ratio, multiply by the no growth value. You find the estimated PVGO from there. You add the PVGO to the no growth value, and you get the estimated enterprise value. Now let's try to look at the implications of Apple's PVGO status from an income approach perspective. Trying to project exactly where will they be in the next five years. So as we found in their price, what's baked in is approximately 2% growth, a little bit over 2% growth over the next 5 years, which is not a crazy number. Not a crazy number at all. I think it's actually rather low. So what I have here is I presented a scenario in which Apple could achieve 2% growth over the next 5 years. Plain simple. I project out revenues, the notepad, the margins on that, gross cash flow, the changes in invested capital and free cash flow. And to further these projections, I have kind of some assumptions that I've made. First and foremost, the most important assumption I'm making here is the value of Apple is purely driven by the fundamentals. Expectations stagnant. In reality, as if Apple starts growing above that rate, expectations will probably rise, or below, expectations will fall. So that's one of the key assumptions we're making here. That 2% over 5 years represents 2% growth in free cash flow in this scenario. And in this scenario, also are making other assumptions. And for the projections, say that there is going to be low impact from Apple's new products, the iPhone 7 and Apple Watch Series 2. Don't believe it's going to essentially add too much in the beginning, and the incremental add-ons later into the future. Believe competition will start to come in. There's going to be some effect, but not too crazy of an effect, as you can see in the margins. I've projected out, not too much of an add-on. And also this involvement with McLaren, the Formula Racing company out in Europe. I don't know what's going on there. I don't know too much about it. But let's just say that they're getting involved, but not too much. And maybe they're trying to find out, should they become a car maker? Should they just try to use the technology, so on and so forth. So that's reflected in the changes in invested capital. But overall, this is how I matched the free cash flow growth of 2.3% over the next 5 years. And this is the scenario I've chosen to kind of, project that out. Now let's look at the estimated scenario. Let's look at the scenario where we instead believe equity research analysts at this 8% growth rate over the next 5 years, long term. And we make some changes. First and foremost, there's a little bit of a higher impact from the new products. Not too much of a higher impact. It is tough to grow revenues when you're starting at around 220 billion. I mean that sounds almost impossible to me. But hey, you gotta grow them somehow, and Apple has shown an ability to do so. I still, because of in a more mature phase, I still don't believe they'll grow too fast, but maybe slightly above the economy. Believe there's going to be higher impact from competition, as it shows through the margins. I mean, there's already surveys out there about how Apple is falling behind Android. Android is making better phones, has better technology. So making that assumption. And to also complement that, Apple is hearing the same things and start getting more involved with this car maker. I mean, they start getting more into that space. They're already building more data centers out in Europe as well. Is that for something cloud related? I mean, I've just heard about that today. I don't know. Nobody knows. But let's just say they're just getting more involved out there in Europe, trying to build their European base in whatever way. That also reflects in higher changes in invested capital. But even with the higher changes in invested capital, which also increases depreciation and overall gross cash flow, still have free cash flow growing overall at a CAGR of 8% over the next 5 years, representing at 1.5 times change from today. So this is one way to attack the income approach, especially in forecasting further out into the future. And this can become a very important tool, especially for early stage valuations. If you're looking at a company and projecting out 10, 15 years to the future, maybe, the percentage of CAGR might not really show what's going on. It could be relatively low, only showing 10, 15%. But, for example, a 14%-ish CAGR over a 10-year span really is equating to the company growing, about 4 times? 4 times the size? Might not be too bad, but maybe it's 4 times the size of today, maybe it's 20 times the size of today. And in that situation, you're probably going to be just looking at revenues. I mean, it's possible, but it's your call to actually tell if that's going to actually happen or not. So let's look at it from another perspective, a market approach perspective, and we'll use McDonald's. We're going to look at different companies that are inside that QSR, quick service restaurant, fast food space. And you have Sonic, Wendy's, Jack in the Box, Yum brands, which mainly Taco Bell and KFC, Dunkin' brands, and Starbucks. Then you have McDonald's at the bottom. Now what you can do is find the discount rates, with the benefit being earnings per share here. Look at betas, look at the size adjustments, find the discount rates, and you can compare it to their market prices, and you can compare across a spectrum, across an entire industry, and see where a certain company lies. As you can see here, McDonald's implied growth rate is about only 1%, and PVGO is only about 5% using those numbers. Whereas the rest of the industry, although the rest of the industry is kind of smaller, they are smaller. They have higher growth rates, higher long-term estimate growth, higher PVGOs. So this is another way you can use the PVGO process. But let's take it a step further. So after looking at those numbers, what you can see as well is that based on the peer group, it looks as if McDonald's is much more along in the corporate life cycle based on the number of restaurants and market capitalization, which we all know. They're definitely on the mature side versus the rest of their competition. This also explains why gross profits to assets, PVGO percentage, and long-term growth estimates are less than the peer group. Makes sense. Being further along in the corporate life cycle, McDonald's doesn't have as many investment opportunities as the rest of their peers. So the best way to maximize their value is to minimize the discount rate. To achieve this, McDonald's has controlled their expenses, leading to a higher operating margin, as well as paid a higher dividend, leading to a higher dividend yield, as you can see in the chart to your right. Given the past sales growth and capital expenditure levels of McDonald's were similar to their peers, I believe the higher margins can lead to higher growth than what is being baked into their stock price relative to the peer group. I mean, the peer group has a lot more expectations baked in, and I believe that McDonald's, although much larger, can kind of meet some of those expectations as well, should be close to the peer group. Based on that analysis, I believe McDonald's PVGO percentage should be closer to 20 to 30%. This equates to approximately 6% 5-year estimated long-term growth rate at the midpoint, leading to a target price of about $150 per share or 27% upside potential. It's another way you can use this process. You can compare it to other companies in the same peer groups, and since you can, especially if you're using CAPM and using EPS as the benefit, just quickly take a glance and grab all the information and see where a company lies in the market, and you can make your case either way. Now, after understanding how the PVGO thought process was used for Apple and McDonald's, let's try to find any more insight from just looking at the different economic benefits, discount rates, and implied growth rates from the PVGO process and long-term projected growth rates by equity research analysts. An investor can quickly screen for investment ideas by just comparing the implied rates to the long-term rates projected by the research analysts to see if the projected long-term growth matches what's implied by the PVGO percentage. We're going to look at two different charts. One's for large caps, another one's for small and mid caps. And just to get an idea, if the sales all the way to the right, as you'll see, if they're green, it means that research analysts' growth projections are greater than the implied growth rates from the PVGO percentage, which is a good sign. If it's red, it means research analysts' growth projections are less than the implied growth rates from the PVGO percentage, which is not good. I mean, usually research analysts are the most bullish, and if PVGO percentage is not even meeting, they're not even higher. If they're lower than the PVGO percentages offering, then that could be a problem. And non-color it's reasonable based on those estimated percentages. So in this first table, the large caps, you see a couple of major companies to your left. You got PepsiCo, you have Boeing, Facebook, Duke Energy, Exxon, Visa, Amazon, Microsoft, Costco. Look at, I made the size adjustment based on where they're at and used EPS as the benefit here. And as you can see from the implied growth rates compared to the long-term estimate, things can go either way sometimes, which can be surprising. So for most companies, their discount rates are less than the market average, meaning these larger companies are expected to be safer than the overall market. This is also the main factor for companies that have long-term growth rates above the PVGO range. If the forecasted long-term growth rates did not fall into the PVGO percentage growth range, it wasn't too far off. If you go back and look at that slide, whenever you saw a green to the right, and if you compared it to the two rates that are projected, it wasn't like it was that much higher. They were usually just slightly above. For the cases with large discrepancies between what analysts project for long-term growth and what PVGO percentage observes, mostly stems from companies that have negative growth expectations. If a company projected 5 years annual growth is only like 1%, or not even a full percentage, I mean, it's like maybe 50 basis points. That's what they're really saying is, we don't expect this company to grow. We're just throwing a number out there. We're expecting things to go downhill. And that's what the PVGO percentage sometimes pushes out. You know, that's what's baked into the market, although research analysts might think a different scenario. Some companies with higher projected growth rates from research analysts, and usually with these bigger companies, it could be just as high as 10% annual, tend to be overvalued, as their PVGO percentage is extremely high, indicating the market overpricing a company's growth potential. And that tends to happen a lot. It's that value versus growth popping up again. When you look at growth stocks, and if they're offering a good growth percentage, people are willing to pay much more for that growth. Now let's take a look at small to mid caps, and we're going to do something a little bit different here. Instead of looking at just the market cap, we're going to look at the enterprise value, and we're going to make an adjustment for operating earnings, operating income. Well, because I believe R&D, research and development expenditures, it's more of an investment versus an expense, I actually just added those back. It made the process really simple. I know this is more of a long-term process I should do with it, but wanted to hurry up and just analyze as many companies as I could, as well as made an adjustment for that benefit using operating earnings instead of EPS or free cash flow, which we've talked about before. And if you look to the far right, making an assumption that the EPS long-term growth is similar to adjusted operating income long-term growth rates, you'll see similar patterns. Matter of fact, you can definitely see a larger discrepancy, to be honest, if you look hard enough. So with using the industry return on capital, which is another thing I forgot to mention, we're using just what the industry is in terms of the discount rate versus doing a full-blown cost of capital. Just a different way to look at a discount rate. Using industry return on capitals, the small to mid cap discount rates are much higher than large caps. Once again, the companies that have forecast long-term growth rates above the derived PVGO percentage range stems from low to negative growth expectations. This is the whole goal. Look for the companies that don't necessarily have the growth baked in. In terms of adjusted operating income, there tends to be a large discrepancy between research analysts' growth forecast and growth expectations derived from PVGO percentage when compared to large caps. This leads to the belief that understanding small to mid cap companies can potentially lead to abnormal returns for an investor. And this idea also plays into that illiquidity effect, or maybe even companies that have too much media coverage that we just pay too much attention to. They're probably the ones that are being the most market efficient, those prices. Whereas if you're looking at a smaller company, those prices aren't as efficient. Just a thought. So, in conclusion, the PVGO thought process coincides with the corporate life cycle. That's one of the key things to keep in mind, and one of the key things I want to stress, that this can be used at different stages of the life cycle. Although free cash flow is the ultimate benefit, at least in my eyes, the thought process can be used to understand a company's market price from any economic benefit, as well as lead to higher accuracy in forecasting different economic benefits. The PVGO thought process can also be used for either an income or market perspective. You can use some of the insight and apply it to a DCF, or you can use some of the insight and just quickly run the numbers for a number of companies, for a peer group, for an industry, and see what you can find. That will be it for this tutorial. I know this one was a little bit long. Well, actually, very long. I didn't know how long it was going to be, but just wanted to give you a full idea of how to apply the process, as well as just show you how versatile the process can be. Now, for the next couple of videos, I'm just going to be valuing different companies, valuing different things I'm seeing. I should be coming up with a video next couple of days over a company I think you will find very interesting. It's been in the news a lot. As well as applying this process also to valuing companies in companies you wouldn't think I would use it for. I'll have more on that later. Thank you so much for your time. Hope you enjoyed what you've seen so far and use the PVGO process. It's all about low expectations here. Thank you. Enjoy the rest of your day.